The most powerful empire in history had no army, no territory, and no king. Yet it controlled the world for 800 years. The year is 1204. Constantinople burns. But while crusaders pillage the jeweled throne room of Byzantium, a single galley slips through the harbor under cover of smoke. No banners, no armor, just silk-wrapped ledgers and a crew of Venetian clerks rowing in perfect silence. They are not warriors. They are accountants, and they have just stolen an empire's worth of trade contracts, customer lists, and diplomatic secrets, documents more valuable than all the gold in the imperial treasury. The ship disappears into the Adriatic fog. History records the fall of Constantinople. It does not record this theft, because the men who orchestrated it do not appear in paintings or chronicles. They have no monuments. They rule from counting houses, not castles. Their weapons are bills of exchange, not swords. Their territory is not land, it is information. For the next 800 years, families like theirs will control the arteries of global commerce, moving silently through centuries of war and revolution, always in the shadows, always holding the ledger. This is not the history of kings. This is the history of the families who financed them and sometimes destroyed them. The architecture of medieval power was built on two pillars: land and lineage. Kings ruled territory. Lords defended it. Peasants worked it. But beneath this visible hierarchy operated a parallel system, one that required no armies and recognized no borders. Merchant families like the Polo, Medici, Fugger, and Rothschild clans understood that true dominion came not from owning land, but from controlling the flow of goods between those who owned it. While monarchs waged wars over vineyards and mountain passes, these families quietly purchased the only thing that mattered: access. Access to ports, access to roads, access to credit networks that could move Florentine gold to Flemish textile markets faster than any royal courier. They built their empires not on conquest, but on information asymmetry. A Venetian merchant in 1250 knew the price of pepper in Kerala 3 months before a German prince did. That knowledge gap was worth more than 1,000 knights. These families thrived in the gaps between kingdoms, in the neutral zones where politics ended and profit began. They married strategically, a Fugger daughter to a Medici son, a Hanseatic trader's niece to a Portuguese captain, weaving a genetic network as sophisticated as any modern corporation's board of directors. The Venetian Republic perfected this model first. By the 13th century, Venice was not merely a city-state. It was a corporation masquerading as a government. Every major trading family held shares in state-sponsored convoys. Profits were pooled, risks were socialized, and information was weaponized. The Republic's intelligence network stretched from London to Samarkand, operated by merchant spies who sent coded dispatches hidden in bales of cloth and wine barrels. When Marco Polo returned from Kublai Khan's court in 1295, he brought more than stories. He brought detailed commercial intelligence on Chinese silk production, Mongol taxation rates, and Central Asian currency exchange mechanisms. His book was entertainment for European courts. His private debriefing with Venetian trade ministers was classified. This was the first modern intelligence agency, run by accountants instead of soldiers. Venice's power rested on a simple principle: control the bottleneck. In an age before overland alternatives, all Eastern goods flowing to Europe had to pass through Venetian warehouses. The Republic charged tariffs, of course, but more importantly, it maintained a monopoly on price information. A Venetian trader knew what Chinese silk cost in Tabriz and what it would sell for in Bruges. Every other European merchant was guessing. But Venice's model had a fatal weakness: geography. The Republic's power depended on Mediterranean dominance, and Mediterranean dominance depended on controlling the spice routes through Ottoman territory. When Constantinople fell to Mehmed II in 1453, the Venetians lost more than an ally. They lost their exclusive pipeline to Asian markets. Ottoman sultans began playing Venetian, Genoese, and Florentine merchants against each other, extracting better terms by threatening to grant monopolies to rivals. The merchant families adapted with ruthless pragmatism. If the old Silk Road was now politically unstable and prohibitively expensive, they would finance new routes. Portuguese and Spanish expeditions to circumnavigate Africa and reach Asia by sea were not projects of national ambition. They were privately funded ventures backed by syndicates of Italian, German, and Flemish banking families. The Fugger family of Augsburg, for instance, financed both Habsburg military campaigns and Portuguese colonial expeditions, ensuring they profited whether Europe expanded by conquest or commerce. When Vasco da Gama returned from India in 1499, his cargo of spices was claimed by the Portuguese crown. It was immediately sold to German banking syndicates who had funded the voyage, bypassing Venice entirely. The Portuguese breakthrough shattered the old order. Within a decade, Lisbon replaced Venice as Europe's spice capital. The price of pepper in Antwerp dropped by 80%. Venetian merchant fortunes evaporated. But the families who had funded both sides of this geographic revolution emerged wealthier than ever. They simply shifted their capital from Mediterranean galleys to Atlantic caravels, from Venetian warehouses to Lisbon trading posts. This was the moment when European trade families stopped being regional operators and became truly global. The Fuggers established branch offices in Lisbon, Seville, Antwerp, and Lyon simultaneously. The Welsers financed German conquistadors in Venezuela. The Medici opened banking houses in London and Paris. For the first time, a single family network could move capital from Bavaria to Brazil, from Florence to the Philippines, all without involving a single monarch or government treasury. And as the 16th century dawned, these families prepared to do something unprecedented. They would finance the colonization of entire continents, reaping profits that would dwarf anything seen in the medieval Mediterranean. The age of merchant princes was ending. The age of merchant empires was about to begin. A single peppercorn in 1580 London was worth more than its weight in silver. Not because pepper was rare. Millions of pounds grew wild on India's Malabar coast. But because 5 families controlled every ship that sailed from Calicut to Lisbon, every warehouse from Goa to Antwerp, every license to trade in the Indian Ocean. They didn't grow pepper. They didn't harvest it. They simply stood between the farmer and the customer, extracting tribute at every port, every checkpoint, every customs house. This wasn't trade. This was systematic extraction, disguised as commerce. And it made them richer than kings. The economics of the spice trade were absurdly simple. Buy low in Asia, sell high in Europe, and prevent anyone else from doing the same. The Portuguese Estado de India, the colonial administration governing Portuguese territories in Asia, was essentially a protection racket operated by merchant families who had purchased licenses from the crown. These captains major paid the king a flat fee for the exclusive right to trade in specific regions. Once licensed, they became de facto warlords, commanding armed flotillas that patrolled trade routes and sank competitors. Independent Arab, Indian, and Chinese merchants who had traded freely for centuries suddenly found themselves forced to buy Portuguese cartazes, essentially naval passports, or have their ships confiscated. The Portuguese didn't invent maritime trade in the Indian Ocean. They simply militarized it and charged rent. Families like the Perestrellos, Cabrals, and Albuquerques rotated through colonial governorships, each tenure a carefully orchestrated plundering operation. A typical Captain Major's 3-year posting to Goa could generate personal profits equivalent to 50 years of aristocratic income back home. But the Portuguese monopoly was already under siege before it fully matured. Dutch and English merchant families, excluded from Iberian trade networks, began organizing their own expeditions. The Dutch East India Company, the VOC, was founded in 1602 as a cartel of 6 competing merchant houses who agreed to stop undercutting each other and instead pool resources to break Portuguese dominance. This was corporate warfare disguised as exploration. The VOC was granted a charter allowing it to wage war, sign treaties, and establish colonies in Asia, powers normally reserved for sovereign states. Families like the Trippe, De Geer, and Bicker clans contributed capital and received shares that traded on the Amsterdam Stock Exchange, creating the first publicly traded corporation in history. But public was a relative term. 85% of shares were held by Amsterdam's merchant elite, the same families who sat on the city's governing council. The VOC wasn't accountable to shareholders in any modern sense. It was accountable to the cartel that created it. For the next 200 years, this single corporation would generate more revenue than most European kingdoms, operating as a privatized empire with its own army, navy, currency, and diplomatic corps. The VOC strategy was ruthlessly efficient. Identify the single most valuable commodity in each region, establish monopoly control through violence if necessary, and inflate prices artificially by restricting supply. In the Banda Islands, the only place where nutmeg grew naturally, VOC forces systematically exterminated the native population and replaced them with Dutch plantation owners. Not conquest for territory, conquest for product exclusivity. The company maintained warehouses full of nutmeg that were never sold, deliberately kept off the market to maintain scarcity pricing in Amsterdam. When rival English merchants attempted to establish trading posts in the Moluccas, VOC troops simply destroyed them and executed the traders. No European government intervened, because the governments were financed by the same merchant families who owned the VOC. The Dutch Republic's governing States General was packed with VOC shareholders. The line between corporate interest and state policy had effectively disappeared. This arrangement generated staggering returns. VOC shares paid average dividends of 18% annually for nearly 2 centuries. A merchant family that invested 1,000 guilders in 1602 could expect to extract 180 guilders in profit every year, compounding indefinitely, while maintaining the same share value. By 1650, 3 megacorporations, the Dutch VOC, the English East India Company, and the French Compagnie des Indes, controlled virtually all European trade with Asia. Behind each corporation stood a small cluster of families who rotated through directorships, arranged strategic marriages, and coordinated policy to prevent destructive competition. When these corporations went to war with each other, and they did, frequently, it was essentially inter-family conflict, commercial rivals settling disputes with cannons instead of lawsuits. The families themselves remained insulated from loss. If a VOC fleet was destroyed, the company absorbed the cost and shareholders received slightly smaller dividends that year. If an English fort in India was captured, the EIC simply issued new shares to fund its reconquest. Risk was socialized among thousands of minor investors. Profits were concentrated among the dozen families who sat on corporate boards and government councils simultaneously. This was extraction capitalism in its purest form. Merchant families had figured out how to privatize profit while nationalizing risk, all under the legal fiction of joint stock companies chartered for the public good. The wealth these families accumulated in the 17th century would become the seed capital for the next phase of their empire, not just controlling trade routes, but controlling the production of goods themselves. They were about to become industrialists. Money doesn't sleep. It doesn't recognize borders. It doesn't pledge loyalty to kings. In 1650, a Rothschild clerk in Frankfurt could move 100,000 ducats to a Medici bank in Florence faster than a royal courier could ride from Paris to Lyon. Not with ships, not with armed guards. With a single encrypted letter containing a numeric code that only 5 families in Europe could decipher. This was the birth of modern finance, a system where wealth became information, where gold in a vault mattered less than a name in a ledger, where power belonged not to those who owned money, but to those who controlled its movement. The Medici perfected banking as political weapon in the 15th century, but it was the Fuggers who industrialized it. Jacob Fugger the Rich, who died in 1525 as the wealthiest man in Europe, understood that lending to kings was more profitable than lending to merchants, if you could enforce repayment. His innovation was brutally simple. Make loans so large that default would trigger national bankruptcy, then demand not just interest, but political concessions. When Charles V needed funds to bribe electors and secure the Holy Roman Emperor title in 1519, Fugger provided 543,000 florins, more than the annual revenue of most European kingdoms. In exchange, Charles granted the Fuggers monopoly rights to Hungarian copper mines, Spanish mercury production, and the right to collect papal indulgences throughout Germany. These weren't loans, they were leveraged buyouts of sovereign assets. Fugger effectively owned portions of the Habsburg Empire's revenue streams. When Charles couldn't make payments, Fugger didn't demand repayment. He demanded more monopolies. The family's account books, meticulously preserved, show a systematic strategy. Identify cash-strapped monarchs, offer emergency loans at moderate interest, then convert debt into perpetual commercial privileges worth far more than the principal. But the Fuggers model had a critical vulnerability. They lent to specific rulers, and when rulers died or were deposed, their heirs sometimes refused to honor debts. The next generation of banking families, the Rothschilds, Barings, and Hopes, solved this problem by lending to states rather than sovereigns. In the 18th century, European governments began issuing bonds, financial instruments that promised to repay principal plus interest over decades, backed not by a king's word, but by a nation's taxing power. Banking families who had spent centuries moving money between cities now became the primary dealers in sovereign debt. The Rothschild family pioneered the multi-node network model. Five brothers established banks in Frankfurt, London, Paris, Vienna, and Naples simultaneously, allowing them to arbitrage bond prices across markets and move capital internationally with unprecedented speed. When Britain needed to finance its war against Napoleon, the government didn't go to the Bank of England. It went to Nathan Rothschild in London, who purchased massive quantities of British bonds and resold them across Europe. Rothschild didn't just profit from the transaction. He effectively determined Britain's cost of borrowing by deciding which markets to access. The bond market transformed these families from wealthy merchants into indispensable infrastructure. By the mid-19th century, no major European government could finance a war, build a railroad, or fund colonial expansion without accessing international bond markets. And bond markets were controlled by a half-dozen banking houses who decided which countries received capital and at what price. When the French government needed to pay war reparations after losing the Franco-Prussian War in 1871, it turned to a syndicate led by the Rothschilds, who organized a 5 billion franc bond issue, the largest in history at that time. But the Rothschilds didn't just facilitate the transaction, they dictated terms. France received the capital it desperately needed, but at interest rates that would generate steady profits for the banking families for decades. This was debt as governance. Merchant families had evolved into shadow chancellors, shaping fiscal policy by controlling access to credit. Nations competed for favorable borrowing terms the same way medieval merchants once competed for spice monopolies. And just as with spices, the banking families ensured that supply remained artificially constrained to maintain premium pricing. By 1900, the banking families had achieved something unprecedented. They had made themselves systemically necessary. A government could replace an army general or a trade minister, but it couldn't replace the Rothschilds, Barings, or Morgans, not without losing access to global capital markets. This wasn't just economic power, it was structural power, woven into the architecture of international finance. When the Barings bank crisis of 1890 threatened to collapse the Argentine economy and trigger a chain reaction of defaults across South America, the Bank of England didn't rescue Barings out of charity. It rescued them because allowing a major merchant bank to fail would have destabilized the entire bond market, destroying trust in financial instruments that hundreds of governments and corporations depended on. The merchant families had become too important to fail. A century before that phrase entered common usage. They had spent 600 years building a system where profit flowed toward them with gravitational inevitability. And as the 20th century arrived, they prepared to deploy this accumulated capital into something even more lucrative: industrial monopolies and colonial extraction on a scale that would make even the spice cartels look modest by comparison. In 1885, a conference in Berlin divided Africa among European powers using maps drawn by men who had never set foot on the continent. But the real decisions had already been made in London boardrooms, Paris banking houses, and Brussels trading companies. King Leopold II didn't personally finance the colonization of Congo. He was backed by a syndicate of Belgian, British, and French merchant families who saw profit in rubber and ivory. The British didn't conquer Egypt for national glory. They did it to protect Suez Canal shipping routes controlled by banking families who held Egyptian bonds. Colonialism wasn't imperialism. It was commercial expansion with gunboats. The scramble for Africa was financed by the same families who had controlled Asian spice routes 2 centuries earlier. But colonial extraction in the 19th century operated on a far more sophisticated model. Instead of merely controlling trade, merchant syndicates now controlled production itself. In the Congo Free State, Leopold's private colony, rubber was harvested through a quota system enforced by private militias funded by Belgian banking interests. Villages that failed to meet quotas faced systematic mutilation and execution, not as colonial sadism, but as industrial management. The violence wasn't incidental, it was the business model. European consumers purchased rubber for bicycle tires and industrial gaskets. They paid merchant companies, who paid Leopold's administration, who paid mercenary forces to extract labor without compensation. The families who financed this arrangement, the Société Générale de Belgique, backed by Rothschild, and other banking houses, received dividends from Congo's rubber exports while maintaining plausible deniability about how the product was obtained. This was capitalism's logical evolution, from controlling routes to controlling resources to controlling people. British colonialism operated with slightly more bureaucratic sophistication but identical economic logic. The British East India Company had effectively governed India for a century before the Crown officially took control in 1858, but Crown control was largely semantic. The same merchant families who had sat on the EIC's board of directors simply shifted their investments into British colonial bonds and railway ventures financed by the India Office. When the British government built 40,000 miles of Indian railway between 1860 and 1900, it wasn't a public infrastructure project. It was a guaranteed return investment scheme for British capital. The colonial government issued bonds to British investors, used that capital to contract British engineering firms, often owned by the same families who held the bonds, and guaranteed 5% annual returns regardless of whether the railways turned a profit. If railway revenues fell short, Indian taxpayers made up the difference. This was risk-free imperialism. Merchant families earned construction profits, operating profits, and guaranteed bond returns, while all costs and risks were externalized to the colonized population. Indian famines in the 1870s and 1890s coincided exactly with massive grain exports to Britain, not because of drought, but because railway networks efficiently moved Indian grain to ports for export while millions starved inland. The ultimate refinement of colonial extraction came with the establishment of chartered monopoly companies that functioned as private governments. The British South Africa Company, founded by Cecil Rhodes and backed by Rothschild financing, was granted authority to govern, tax, and administer justice across vast territories in southern Africa, essentially creating a corporate state. Rhodes' strategy was vertically integrated imperialism. His company controlled diamond and gold mining, the railways that transported minerals, the ports that exported them, and the banks that financed all of it. When indigenous populations resisted, the company used its private army, paid for with investor capital, to crush them. When rival mining companies attempted to compete, Rhodes used political pressure, price manipulation, and occasional sabotage to drive them to bankruptcy, then purchased their assets at discount. By 1902, Rhodes De Beers Consolidated controlled 90% of global diamond production. This wasn't achieved through superior geology or mining technology. It was achieved through systematic monopolization backed by military force. The families who invested in these ventures received extraordinary returns. De Beers paid dividends of 25 to 40% annually for decades, returns possible only because labor costs were zero and political opposition was violently suppressed. By 1914, merchant families had constructed a global system of extraordinary efficiency. Raw materials extracted in Africa and Asia using coerced labor processed in European factories using wage labor, then sold back to colonies at markup prices enforced by colonial tariff systems. The families who had financed this apparatus owned shares in mining companies, textile mills, shipping lines, railways, and the banks that financed all of it, capturing profit at every stage of production and distribution. They had transcended their medieval origins as middlemen. They were no longer just facilitating trade. They had become the trade system itself, a self-reinforcing cycle where capital generated more capital with mathematical inevitability. And when the First World War shattered this arrangement, destroying empires and redrawing borders, the merchant families discovered something remarkable. Political chaos was good for business. Governments desperate to finance war mobilization needed capital urgently and were willing to pay premium interest rates. Destroyed infrastructure would need rebuilding. New nations would need new banking systems. The war that ended the old world order would inaugurate the most profitable period in the history of merchant dynasties. They had survived 700 years by adapting to every crisis. This would be no different. On August 4, 1914, Britain declared war on Germany. By August 5, The Rothschild banks in London and Paris were arranging emergency credit lines for their respective governments. By August 6th, arms manufacturers owned by merchant families were receiving orders that would run for 4 years straight. War is expensive. Someone has to finance it. Someone has to supply the steel, explosives, uniforms, and canned food. The families who controlled those resources didn't start the war. They didn't need to. They just needed to ensure that when nations destroyed each other, the bills were paid, with interest. The First World War was the first industrialized conflict. An industrialized war required industrialized financing. Governments couldn't simply seize supplies and promise later payment as they had in previous centuries. Modern warfare consumed resources so rapidly that suppliers demanded guaranteed payment or they would halt production. The solution was war bonds. Governments sold debt to their own citizens and to international investors, promising to repay principal plus interest after victory. Banking families who had spent the previous century developing bond markets now became indispensable. J.P. Morgan and Company handled virtually all Anglo-French bond sales in the United States, earning commissions on billions of dollars of debt while also serving as purchasing agent for Allied military supplies. Morgan's bank didn't just finance the war, it decided which American companies received Allied contracts, effectively controlling a substantial portion of the U.S. wartime economy. This was the ultimate realization of merchant power. Morgan's firm was simultaneously creditor to France and Britain, purchasing agent for their armies, and investor in the companies supplying them. Every transaction generated fees, every bond sale generated commissions, every munitions order generated profits. The European banking families faced a more delicate situation. Many had branches in countries that were now enemies. The Rothschild banks in London, Paris, Vienna, and Frankfurt found themselves technically financing opposite sides of the war. The solution was studiously maintain neutrality. Each branch financed its respective government, while the family as a whole refused to take political positions. This wasn't moral cowardice, it was survival strategy. By remaining technically neutral while financially indispensable to all sides, the banking families ensured that regardless of who won, they would remain essential to post-war reconstruction. The German Warburgs helped finance Germany's war effort, while their American relatives helped finance the Allies. The Nobel family, owners of the world's largest explosives manufacturers, sold munitions to both Germany and Russia simultaneously until the Russian Revolution. This wasn't treachery, it was business logic taken to its ultimate conclusion. Merchant families had never sworn loyalty to nations, only to capital preservation. War was simply the most extreme expression of market demand, and they were suppliers without ideology. The war's most profitable sector was shipbuilding and shipping. Submarine warfare made Atlantic crossings extraordinarily dangerous, which meant insurance rates skyrocketed and freight charges increased exponentially. Merchant families who owned shipping lines could charge whatever the market would bear, and the market, desperate for food, munitions, and raw materials, would bear almost anything. The Cunard Line, the White Star Line, and other major shipping companies generated profits during the war years that exceeded their cumulative earnings for the previous 2 decades. But the real money was in reconstruction contracts. As the war ground toward its inevitable conclusion, banking families who held government bonds began quietly purchasing shares in steel mills, cement factories, and construction firms, companies that would be essential for rebuilding destroyed cities. When the armistice was signed in November 1918, these families owned both the debt that governments owed and the companies that governments would hire to rebuild. They would profit twice, once from interest payments on war bonds, and again from reconstruction contracts. The destruction of Europe was the greatest capital deployment opportunity in modern history, and the merchant families positioned themselves to capture the majority of reconstruction spending. The Treaty of Versailles in 1919 officially ended the war, but it also created the conditions for the next phase of merchant family wealth extraction. Germany was saddled with 132 billion gold marks in reparations, an impossible sum deliberately designed to take decades to repay. But the impossibility was the point. Germany would need to borrow money to make reparation payments, and the same banking families who had financed the Allied victory would now finance German reconstruction at premium interest rates. The Dawes Plan of 1924 and the Young Plan of 1929 were both negotiated by committees of bankers representing American, British, and French financial interests. These plans restructured German debt and arranged new loans to Germany, allowing it to make reparation payments to the Allies, who then used those funds to repay war debts to American banks. It was a closed financial loop. American banks lent to Germany. Germany paid reparations to France and Britain. France and Britain repaid America, and American banks lent to Germany again. At every stage, interest accrued. The war had ended, but the profit machine it created continued running for another decade until it finally collapsed into the Great Depression. And when that collapse came, the merchant families would discover they had become so entangled with national governments that their survival would require unprecedented intervention. The beginning of their transformation from private dynasties into something even more powerful, the architecture of the modern financial system itself. October 29, 1929. Black Tuesday. The stock market collapsed, erasing $14 billion in paper wealth in a single day. Banks failed. Businesses shuttered. Unemployment reached 25%. Politicians called it a natural disaster, an unpredictable catastrophe. But the merchant families knew better. They had created the bubble themselves: easy credit, margin trading, fraudulent valuations, and they had also positioned themselves to profit from its collapse. Because market crashes, like wars, are only disasters for those without capital. For those who have cash when everyone else is desperate, crashes are buying opportunities. The origins of the 1929 crash lay in the debt structures created during World War I and its aftermath. American banks had lent billions to European governments, who used that capital to rebuild and pay reparations. But by the late 1920s, it was becoming clear that Germany couldn't sustain reparation payments, which meant France and Britain couldn't repay their American war debts, which meant American banks were sitting on massive portfolios of uncollectible foreign debt. Simultaneously, the U.S. stock market was inflating into a speculative bubble, driven partly by these same banks offering margin loans to investors. Customers could purchase stocks with 10% down and borrow the other 90% from brokerage houses. Houses often owned by the same banking families that were quietly selling their own stock positions at peak prices. When the inevitable collapse came, margin calls forced leveraged investors to sell everything, accelerating the crash. The banking families who had fueled the bubble with easy credit then used their accumulated cash to purchase assets at depression prices: factories, real estate, and the stocks they had sold at the peak. It was a classic pump and dump at civilizational scale. But the Depression created an unexpected problem for the merchant families. System-wide collapse threatened to destroy the very financial infrastructure they depended on. When thousands of banks failed, taking their depositors' savings with them, public rage threatened to produce genuine political reform: nationalization of banks, wealth redistribution, even socialist revolution. The merchant families had always operated best in stable systems with predictable rules. Chaos and popular uprising endangered their assets. The solution was to become indispensable to government itself. In the United States, the Glass-Steagall Act of 1933 separated commercial banking from investment banking. But the same families simply reorganized their empires into separate corporate entities that they still controlled. More importantly, the Roosevelt administration's response to the Depression required unprecedented government intervention, which required unprecedented borrowing. Between 1933 and 1940, federal debt tripled, all of it financed through bonds underwritten by Wall Street banks. The New Deal didn't threaten banking interests. It rescued them by creating massive new demand for their core product, government debt. The Depression also accelerated the centralization of monetary power through central banks. The Federal Reserve, established in 1913, had been a relatively weak institution during its first decades. But the banking crisis of 1929 to 33 dramatically expanded its authority. The Fed gained power to regulate bank reserves, set interest rates, and act as lender of last resort, powers that made it the single most important financial institution in the American economy. Similar centralizations occurred globally. The Bank of England nationalized its operations, the Reichsbank was reorganized, and new central banks were established in countries that previously lacked them. On the surface, this looked like the triumph of public control over private banking. In reality, it was the opposite. Central banks were staffed by executives recruited from major banking houses, appointed by politicians who depended on those same banks to finance their governments. The merchant families didn't lose control. They just moved one level up, from owning individual banks to influencing the institutions that regulated all banks. A Rothschild or Morgan partner couldn't directly set interest rates anymore, but they could be appointed to central bank advisory boards, or their protégés could be appointed as governors. By 1940, the merchant families had achieved something extraordinary. They had transformed a crisis that should have destroyed them into a crisis that made them structurally indispensable. Governments now depended on bond markets to finance everything from military spending to social programs. Central banks, notionally public institutions, were staffed by alumni of private banks and remained closely coordinated with major financial houses. The gold standard had been abandoned, meaning currency value was now determined by central bank policy rather than physical metal, a shift that gave enormous power to the institutions that set monetary policy. And most importantly, the Great Depression had established a precedent. When the financial system faced collapse, governments would intervene to save it, using taxpayer money if necessary. This was the origin of moral hazard in modern finance. The understanding that the largest financial institutions were too important to fail and would be rescued regardless of how recklessly they had behaved. The merchant families had spent 700 years building a system where they profited from trade, then from colonization, then from war. Now they had created a system where they profited from government itself, continuously and inevitably, through the simple mechanism of sovereign debt. They no longer needed monopolies or military force. They had become the system. July 1944. While Allied troops fought across France toward Berlin, 730 delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their mission: design the global financial system for the post-war world. The delegates debated currency stabilization, trade liberalization, and development financing. But the real decisions weren't made in public sessions. They were made in private meetings between American, British, and European banking representatives who ensured that whatever system emerged, it would require their services to function. They designed a global order with themselves at its center. The Bretton Woods system established two institutions that would define global finance for the next 80 years: the International Monetary Fund and the World Bank. On paper, these were multilateral public institutions designed to promote currency stability and fund development. In practice, they were mechanisms for extending American financial dominance globally, and American financial dominance meant dominance by the Wall Street banks that controlled dollar flows. The IMF's founding mission was to provide emergency loans to countries facing balance of payments crises. But IMF loans came with conditions. Borrowing countries had to adopt structural adjustment programs that typically required privatizing state-owned industries, removing trade barriers, and opening their economies to foreign investment. These conditions were drafted by IMF economists, many recruited from American and European banks, and they consistently favored policies that benefited international capital over local populations. The merchant families who had once controlled spice routes now controlled the conditions under which developing nations could access international credit. The extraction mechanisms had evolved, but the underlying logic remained unchanged. The World Bank's stated purpose was to finance reconstruction in war-torn Europe and development in poor countries. Its actual function was to create debt dependency. The bank funded massive infrastructure projects, dams, highways, power plants. In developing nations, projects that required borrowing billions of dollars at interest. These loans were typically made to governments, which meant taxpayers would repay them over decades. But the projects themselves were built by international contractors, often American and European firms connected to the banking families who held World Bank bonds. A typical World Bank project worked like this. The bank lent $500 million to an African government to build a dam. That government hired a European engineering consortium to design it and an American construction firm to build it. These firms charged premium rates and often delivered substandard work, since the borrowing government had little leverage to enforce quality. The $500 million flowed from the World Bank to the government to the contractors, who banked their profits while the government was left with debt to repay, plus a dam that might or might not function properly. The merchant families who held World Bank bonds earned steady interest, the contractors made construction profits, and the borrowing nation's taxpayers shouldered the burden for generations. The Bretton Woods system also established the U.S. S. Dollar as the world's reserve currency, backed by gold at $35 per ounce. This gave the United States, and by extension, the banking families who controlled dollar lending, extraordinary power. Any country that wanted to trade internationally needed dollar reserves, which meant they needed to export to America or borrow from American banks. This created permanent demand for U.S. Treasury bonds, because central banks held their reserves in dollars, typically in the form of Treasury securities, and permanent demand for services of banks that facilitated dollar transactions. When Britain and France faced currency crises in the 1950s and 60s, they had to negotiate with American banks and the IMF for rescue packages. Countries that attempted to develop independent of this system, like Egypt under Nasser or Chile under Allende, faced financial warfare, credit cutoffs, trade sanctions, and capital flight organized by international banks. The merchant families had achieved a level of power that would have been inconceivable to their medieval ancestors. They had made their currency indispensable to global trade, ensuring that every transaction, everywhere, generated fees that flowed toward them. By 1970, the post-war order had created unprecedented wealth concentration. The top 1% of American households controlled 30% of national wealth, with the merchant banking families occupying the apex of that pyramid. But the system also contained a fundamental contradiction. The United States was running permanent trade deficits, exporting more dollars than it took in, while promising to redeem those dollars for gold at a fixed rate. Eventually, foreign central banks began demanding gold instead of holding dollar reserves. In 1971, facing the prospect of depleting Fort Knox, President Nixon unilaterally ended dollar-gold convertibility. This should have triggered a currency crisis. Instead, it liberated the system from any external constraint. Currencies now floated against each other, their values determined by central banks and market forces, forces that the banking families had spent centuries learning to manipulate. The end of the gold standard wasn't the collapse of the merchant family system, it was the completion of it. Money was now purely abstract, backed by nothing but government promises to repay debt. And the families who controlled the debt markets controlled money itself. They had transcended even the physical constraints of precious metals. Wealth had become pure information, numbers and ledgers, and they owned the ledgers. In 1980, the American economy produced cars, steel, and electronics. By 2000, its primary export was financial instruments, derivatives, securitized debt, credit default swaps, products so complex that even the bankers who sold them couldn't fully explain what they were. This wasn't an accident. This was strategic. The merchant families had discovered that manufacturing physical goods required factories, workers, and regulatory compliance. But manufacturing financial products required only mathematics and leverage. And leverage, unlike factories, could be infinite. The deregulation of financial markets in the 1980s and 90s was the greatest gift governments ever gave the banking families. The Glass-Steagall Act, which had separated commercial and investment banking since 1933, was progressively dismantled and finally repealed in 1999. Banks could now gamble with depositor money, using federally insured deposits to finance speculative trading. The Commodity Futures Modernization Act of 2000 exempted derivatives from regulation, creating a shadow banking system worth trillions of dollars that operated with zero oversight. These changes weren't imposed by politicians against the bank's will. They were drafted by banking industry lawyers, promoted by industry-funded think tanks, and passed by politicians who received massive campaign contributions from financial firms. The revolving door between Wall Street and Washington became a highway. Treasury secretaries were recruited from Goldman Sachs and returned to Goldman Sachs after their terms. Fed governors came from J.P. Morgan and went back to J.P. Morgan. Regulatory agencies were staffed by alumni of the firms they were supposedly regulating. The merchant families had completed their capture of the state apparatus. Securitization transformed the banking industry from a service business into a manufacturing business. Banks no longer held mortgages on their books. They originated loans, packaged them into securities, and sold them to investors. This allowed them to make far more loans than their capital base would traditionally permit. Instead of lending $1 billion and earning interest over 30 years, they could lend $1 billion, securitize it, sell it for $1.05 billion, and immediately lend another $1 billion using the proceeds. The incentive structure was now completely decoupled from loan quality. Banks didn't care if borrowers could repay. They cared only that loans could be securitized and sold. Rating agencies, paid by the banks to evaluate these securities, consistently gave them AAA ratings regardless of underlying loan quality. This was how subprime mortgages, loans to borrowers with terrible credit, got packaged into securities and sold to pension funds as safe investments. The merchant families who controlled the major investment banks understood exactly what was happening. They weren't naive. They were originating toxic loans, securitizing them, selling them to unsuspecting investors, and simultaneously betting against those same securities through credit default swaps. They were manufacturing time bombs and buying insurance that paid out when the bombs exploded. The 2008 financial crisis was the inevitable result of this system. When housing prices stopped rising, borrowers began defaulting. Mortgage-backed securities lost value. Banks that had borrowed heavily to purchase these securities faced insolvency. But these weren't small regional banks. These were the largest financial institutions in the world, all interconnected through derivatives contracts worth trillions of dollars. If Lehman Brothers failed, it would trigger failures at AIG, which would trigger failures at Goldman Sachs, which would trigger failures at Bank of America, creating a cascading collapse that would freeze the entire global financial system. So governments intervened with the largest bailout in human history, $700 billion from the U.S. Treasury, trillions more from the Federal Reserve, and similar programs in Europe and Asia. The banks that had created the crisis were rescued using taxpayer money, while millions of homeowners lost their houses. No senior banking executives went to prison. Most weren't even fired. They paid fines, paid from corporate accounts, not personal wealth, and continued operating. The merchant families had achieved ultimate impunity. They could destroy the global economy and be rewarded for it. The aftermath of 2008 should have been a reckoning. Instead, it was an acceleration. Central banks responded to the crisis by implementing quantitative easing, buying trillions of dollars of government bonds and mortgage securities, injecting money directly into financial markets. This drove asset prices to record highs. The stock market recovered and then soared past pre-crisis levels. Real estate prices rebounded. The wealthy, who owned assets, became exponentially wealthier. The merchant banking families, whose firms had been rescued and whose wealth was held in financial assets, benefited from the largest government-sponsored wealth transfer in modern history. Meanwhile, median wages stagnated, homeownership rates declined, and wealth inequality reached levels not seen since the Gilded Age. The system had been stress-tested and proven. No matter how recklessly the banking families behaved, no matter how much damage they caused, governments would intervene to protect them because the alternative, systemic collapse, was politically unacceptable. They had achieved what medieval merchant princes could only dream of. They had made themselves indistinguishable from the state itself, so entangled with government that their survival was necessary for government's survival. 800 years of evolution had culminated in this: private profit, socialized risk, and absolute structural immunity. The year is 2010. A new technology emerges: Bitcoin. Decentralized. Peer-to-peer. No banks required. Early enthusiasts call it revolutionary. The end of financial intermediaries. Freedom from merchant family control. The banking families watch quietly. They've seen revolutions before: the printing press, the telegraph, the internet. Each time, people declared the old order finished. Each time, the families adapted, infiltrated, and eventually captured the new technology. Cryptocurrency wouldn't be different. It would just be another asset class to trade, another market to dominate. The revolution would be financialized. Within 5 years, the banking families had fully colonized cryptocurrency. Goldman Sachs, JP Morgan, and other Wall Street firms that had initially dismissed Bitcoin as a fringe curiosity established dedicated crypto trading desks. They didn't need to understand the libertarian philosophy behind cryptocurrency. They only needed to understand that volatility creates trading opportunities, and trading opportunities generate fees. Banks began offering cryptocurrency custody services, derivatives contracts based on Bitcoin prices, and investment products that allowed institutions to speculate on crypto without actually using the underlying technology. This was the genius of financialization. You didn't need to believe in a technology or support its goals. You only needed to create financial products around it. By 2020, The majority of Bitcoin trading volume occurred not on decentralized exchanges, but through financial intermediaries, the same banks that Bitcoin was supposedly designed to replace. The merchant families had done it again. They had taken a technology created explicitly to circumvent them and made themselves indispensable to its operation. The 2020s brought a new frontier: central bank digital currencies. Governments worldwide began developing digital versions of their fiat currencies, controllable through centralized ledgers. The public justification was efficiency and financial inclusion. The actual effect was surveillance and control unprecedented in human history. Every transaction would be traceable, every payment potentially programmable with conditions and expiration dates. The merchant banking families enthusiastically supported this development. They understood that central bank digital currencies wouldn't replace commercial banks. They would require commercial banks to operate. Someone would need to provide the customer interfaces, wallets, and payment infrastructure. Someone would need to process the transactions and provide liquidity. That someone would be the same banking families who had been processing transactions for 800 years, now collecting fees on digital rails instead of physical ones. Technology had changed. The extraction mechanism had not. The COVID-19 pandemic of 2020 to 2021 provided another extraordinary wealth transfer opportunity. Central banks globally implemented even more aggressive quantitative easing than during 2008. Governments distributed trillions in relief payments and business loans. Asset prices soared to absurd levels. Meanwhile, the banking families who controlled asset management firms, BlackRock, Vanguard, State Street, used cheap central bank credit to purchase millions of homes, creating artificial scarcity in housing markets and converting owner-occupants into renters. This was feudalism reimagined. Instead of peasants working lords' lands, middle-class families would now rent from institutional landlords backed by merchant banking capital. The American dream of homeownership was being systematically dismantled and replaced with permanent rentership. And because these purchases were financed with near-zero interest credit provided by central banks, the banking families risked almost nothing while extracting steady rental income and benefiting from property appreciation. They had figured out how to monetize housing itself, converting a basic human need into a permanent revenue stream. By 2025, 8 centuries after Venetian merchants stole Constantinople's trade secrets, their descendants had achieved a form of power that transcended anything their ancestors could have imagined. They no longer needed to control trade routes or colonies. They didn't need armies or factories. They had embedded themselves so deeply into the architecture of modern capitalism that they had become the system itself. Central banks existed to maintain financial stability, which meant protecting the institutions the merchant families controlled. Governments existed to enforce laws, which meant protecting property rights that legitimized generational wealth concentration. Technology companies created new platforms, which the banking families immediately colonized with financial products. Every innovation, every crisis, every reform became another opportunity for extraction. They had spent 800 years learning a single lesson: adapt to survive, survive to extract, extract to accumulate, accumulate to entrench. And they had learned it perfectly. The secret families who controlled global trade hadn't disappeared into history. They had become invisible because they had become everything: the creditors, the landlords, the investors, the intermediaries. They weren't outside the system manipulating it. They were the system. And the system, as always, was working exactly as designed. Power has a structure. It builds slowly, invisibly, across generations. A Venetian clerk in 1200 recording silk prices in a ledger. A Fugger banker in 1500 financing a Habsburg emperor. A Rothschild in 1800 arranging bonds for Napoleon's enemies. A Morgan partner in 1900 organizing industrial trusts. A Goldman executive in 2000 engineering mortgage securities. A BlackRock portfolio manager in 2020 buying residential neighborhoods. Different centuries, different technologies, different markets. Same architecture, same families, same logic. Own the ledger, control the flow, extract at every node, and never, ever let the system collapse completely, because the system is you. The merchant family's greatest achievement was accumulating wealth. It was constructing a system where accumulation became automatic and irreversible. Every mechanism they built reinforced the others. Banking systems that require government bonds created permanent demand for their services. Central banks staffed by their alumni ensured monetary policy favored asset holders. Deregulated financial markets allowed leverage and risk-taking with publicly guaranteed downside. Tax structures that favored capital gains over wages ensured wealth compounded faster than labor could ever generate it. Educational institutions endowed by merchant fortunes trained future generations of economists and policymakers to view this system as natural and inevitable. Media companies owned by financial interests framed all economic questions in terms that legitimized existing arrangements. This wasn't conspiracy, it was structural. Each piece of the system existed independently, created for seemingly rational reasons, but together they formed an integrated architecture of extraction that required no ongoing coordination to operate. It ran automatically, like a machine designed to concentrate wealth upward indefinitely. The families themselves evolved beyond individuals. Early merchant dynasties depended on talented patriarchs, a Jacob Fugger, a Nathan Rothschild. But modern merchant power is institutionalized through trusts, foundations, and interlocking corporate boards. The Rockefeller family fortune isn't held by Rockefellers anymore. It's managed by Rockefeller trusts that will operate for centuries regardless of whether any living Rockefellers are competent. The Rothschild banking empire isn't run by Rothschilds in the traditional sense. It's operated by professional managers who implement strategies designed generations ago. Family names became brands. Brands became institutions. Institutions became immortal. This solved the historical problem that destroyed medieval dynasties: incompetent heirs. Modern merchant families don't need competent heirs because individual family members are irrelevant. The architecture sustains itself. This is capitalism's ultimate innovation, not creative destruction, but the elimination of destruction entirely through structural entrenchment. The families achieved perpetual motion, wealth generating more wealth without any need for skill, effort, or even the continued existence of the families themselves. Resistance has always failed because resistors misunderstand the nature of the system. Populist movements target individual villains, the greedy banker, the corrupt politician, without recognizing that individuals are interchangeable parts in a structural machine. Occupy Wall Street chanted, "We are the 99%, but could inarticulate specific demands because the system they opposed was a conspiracy of evil people, but an architecture of legal relationships that appeared neutral and legitimate. Socialist movements promised to redistribute wealth, but discovered that state ownership simply replaced private merchant families with state bureaucrats who reproduced the same extraction mechanisms. Revolutionary movements overthrew governments, but found that new governments needed banking systems, which meant negotiating with the same international financial institutions on similar terms. The only movements that truly threaten merchant family power are those that propose dismantling the architecture itself, abolishing interest-bearing debt, nationalizing banking without recreating extraction mechanisms, fundamentally restructuring property relations. But these movements face a coordination problem. The global financial system is so integrated that no single nation can exit without facing capital flight, trade isolation, and economic collapse. The merchant families don't need to defeat resistance. They just need to wait for it to negotiate. The merchant families who controlled global trade for 800 years didn't disappear. They didn't lose. They evolved into something far more powerful than their medieval ancestors. They became the unconscious logic of the modern world. When central banks make decisions, they think with merchant family assumptions. When governments design tax policy, they work within frameworks constructed to favor capital. When ordinary people plan their retirements, they invest in markets dominated by institutions the families control. The system has become so total that most people living within it cannot imagine alternatives. Medieval peasants could envision a world without feudalism. They knew it was constructed by humans and could be changed by humans. Modern citizens cannot envision a world without debt-based finance, property-based wealth, and market-based distribution of resources. These appear natural, inevitable, eternal. That is the measure of merchant family success. They built a system so comprehensive that it no longer needs defenders because it has no visible outside. There is no alternative because they have made themselves definitional. They are not the secret rulers of capitalism. They are the architects of a world where rulership has become invisible because it operates through structures we no longer recognize as power. 800 years of extraction, adaptation, and evolution culminated in this. A system where wealth flows upward continuously, automatically, inevitably, not through force or conspiracy, but through the simple logic of accumulated advantage embedded in every law, every institution, every assumption about how economies should work. The secret families won not by conquering the world, but by becoming indistinguishable from it. History teaches us that empires fall. Rome collapsed. Constantinople fell. The British Empire dissolved. But the merchant families who financed all of them endured. They endured because they never confused themselves with the empires they served. They didn't care about flags or national glory. They cared about contracts, and contracts outlast nations. The ledger never closes. It just gets transferred to new hands, hands that learn from the old ones that power isn't about visibility or monuments. It's about structure. It's about being the one who records the debts, sets the terms, and ensures that payments always flow upward, generation after generation, century after century. The families who controlled global trade for 800 years are still here. You just call them by different names now. And they're still counting.